I'll pass you over to Tom Williams. Ready, Tom?
Yeah, thanks, Peter. Tom Williams here. Hi, everybody. Thank you for tuning in. And the market screen. No screen, right, okay. Everybody got the screen up? Type your questions or whatever. Rita's looking at her screen and she can call out any questions that you have or want answered. That'd be wonderful. Gavin is in Poland with his whole family. 2 kids which are a bit noisy, and a wife, and his wife, I should say. Doesn't sound very good, and a wife, and his wife, and he's out there as we speak. So good luck to him, good wishes to him, and I hope everything works out okay for him. Okay, so the market's basically been weak. We saw way at the top, we analyzed it. There it is, look. Can you all see that? Now, we saw all this, look. This is basically a serious sign of weakness right here. Trap up move, the dialog box tells us, which is great, which it is. Look back on the previous newsletters or whatever, and we describe all of this. Right. I know it's easy in hindsight. I'm sorry for that. But don't forget, the market's been in that bull run for many, many weeks, even months. We were overbought when you're above these trend lines. And once you see this sort of thing with these kind of up thrusts, that's a serious sign of weakness. Now, the market moved forward from there, look. Now, okay, this looks like a test. Now, don't forget that I think there's start of distribution here. I mentioned it at the time. It showed up better on a weekly chart. It was more or less, looked to me like what we call a buying climax, where a lot of traders rush in buying, and the professional money take the opportunity to unload their holdings onto these new buyers. All sorts of people do that. It's a herd instinct. Banks do it, believe me. All sorts of people rush in and buy at the top. Okay, so now that's fine, but they don't want the market to collapse too far on them, so they have to hold the market up normally. And even though here, look, you've got what looks like a test, but if you look at the follow-up bar, look, that black bar, that looks suspiciously like a no demand up bar. We went through all this in previous sessions or newsletters. We are overbought, look, here. Right, and then so here, and then Monday, I believe that was Monday, right? Last Friday. Now I remember talking about that bar. That's right. I remember clearly saying on that bar that we saw, right, a widespread down, closed near the low, on a slight increase in volume as it rushes towards a former area of support, which is here, look, right, is normally a sign of weakness, and you'd expect lower prices. And that stands out because you've got all this behind you, look. That's why that particular bar stood out. All right, you've got no demand here. You've got this sort of up thrust of this black bar. I mean, even that test, there's no result with the test. If that market was bullish, the professional money see these tests and off they go. But it's a failed test. So when you see these wide spreads down, close near the low on a very slight increase in volume, as it pushes down, it's a sign of lower prices. It's not going to recover. But that was Friday. I remember saying that. Monday, it's going to be Monday, look. It looks like a test. It's a black bar, right? But it's a failed test because look at that volume on it. If that was a genuine test for Monday, I say they like to test the market on a Monday, the volume would be low. And then the professional money are fully aware of that, right? The computer will color that volume pink if it's low. Don't forget you're dealing with the S&P 500 here. So the volume is not as clear as I'd like it. Be ideal to have tick volume, but I'm afraid we don't have tick volume. Okay, so that failed Monday, Tuesday, Wednesday, now Thursday. Here. Yeah. Yeah.
There's a question from Edmund. Hello, Edmund. Edmund's asking, Tom, is yesterday and today's up move off of that that's a 1600 level it's sitting on at the bottom there, Tom. Is it a brief bounce or is this the start of a new up move? I don't see stopping volume, so I am expecting at least a test off of the lows.
I'd say categorically no, it isn't. Why should it be? I mean, you're in a weak market and they're distributing. They're not buying. They may try to kid you on they are, and you may get a bit of an up move. But that's whole part of the deception. To go into a serious bull move or a bull move, right, you've got to see signs of strength coming in. And they will appear on down bars, narrow spreads, ultra high volume, and very high, ultra high volume. And then you know that the professional buyers have decided they're going to start buying some. We haven't seen that. Now the market may pop up and down, and you analyze it on the shorter time frames, but this is not what you just said, nowhere near it. Matter of fact, it looks like the opposite. So you have to be aware. Don't fall into traps. Before that market can go up, you've got to see serious buying taking place. Now they're distributing. The market's weak. And they do have to hold the market up so it could sell more on the next wave up. So be aware of that. They'll fool you. They'll mark it up, make it look as if it might be strong. Who knows what they do? But you, as a professional trader, have to understand that. Right, okay. What's his daily chart? Right, okay, let's see what's happened. Put the that 20 bar chart up. This. That's it. Yeah, I mean, there's no reason why I particularly want to look at this. No, well, no. Better put the S&P. It'll look very, very similar. Look very similar. Okay, now this is a 20-minute time period, right? Now this here was a news event. Now you've got shakeouts back here, look, there's some buying. Okay, but here, the news event, this happened at, was it 1 o'clock? 1:30 UK time. Right, 1:30 UK time. Right, they let you know, it's all well advertised, that this is the news coming out that's going to help you into your trading. Right, so the first thing they do, they ram it down, look, to mislead you as much as possible, catch stops or whatever. Widespread up, closed near the high, done very rapidly. This tends to cut you out of any trades because you haven't had time to get in, and then you think, oh, I've missed that. That's the whole idea. Everything they do is for their benefit, not yours. On that, it drifts sideways for just 3 bars, look. There's little or no selling pressure on these bars. They have another little sort of test here. There is supply present, look. But still goes up, look. And the supply is definitely present. Look at that high volume. Red arrows appearing, look. Right. Like reading a book here. Like a novel. Like, yeah. We got a big novel for you. Now, if you study that, right, and every word in there is telling you a story, and you will know more about the market than most people on the face of this earth. And that's why it's rolled over, look. And that's why at the moment you don't get caught in this, do you? And that is an upthrust here, which is a sign of weakness, look. Does that all make sense? It's all there. You ignore the signals at your peril. Because very often people come in and they get very, cocky at reading the chart. Oh, I don't need signals. I knew one guy that turned them off. He said, oh, I don't need them. But I said, ignore the signals at your peril. And I think you'll find I'm right, because the market is devious, it's cunning, it's misleading. It has to do it automatically, because that's how the market works. It's not there to help you. It's there to make you lose money. And 90% of all traders that try to trade this lose money. 10% win, apparently. So you can't argue with statistics. And we want to move you over to the 10% to make money. Right? And there's quite a few hurdles that you have to get over. Not just reading the market, but are you personally ready, geared up to understand this in relation to the news and other things? But that's an upthrust. So you expect lower prices when you see that. I mean, Rita here, she's traded several successful trades yesterday, and Peter does. But once they made a few $100, dollars, they're off. They've made their little bit of money, and that's it. They're happy. And that's how you do it. We call that scalping. But as you get more and more skilled, you're obviously going to trade more contracts, and you can go in different. There's so many different ways you can trade these markets. And that's why we can't possibly tell you exactly when to buy, when not to buy. I mean, Gavin's got this new project coming out. I don't think he seems to understand that you need concentration to pick up these setups, but we'll see what happens. He's put my name down the list. He's never asked me if I'm going to participate or not. Same as Rita. But we'll see what happens anyway. Any questions here? This is a 20-minute S&P 500 running now live at 5:30, 5:45 UK time. Yeah, well.
No, sorry, no, there are a few comments, but no questions on this chart.
Any questions? Yeah, you say so.
Oh yes, I was saying ask some questions to the room. I know you've already been asked to ask questions. Oh, what's coming now, Rita? Anything there?
All right, I'll just read out. Yeah, thank you to all of you who've said sent good wishes to Tom, and glad that he's well now and back with us. Yes, thank you. Okay. Right. Okay. Well, I'll just show you one thing then. Hang on. Because Edmund, thank you, Edmund, for your comments about my blog. Yes, yesterday I had a lovely trade, and I'll just show it. Because actually I wasn't even expecting. I've been away at a very big agricultural show with a friend who comes from Wales, and he makes something what they call a bave, which is a duvet, which is stuffed with wool basically, and it's anyway. I was helping him. He's all the way from Wales. So anyway, so I wasn't expecting to trade, but I came home and once it's just obvious. I sat down, looked at the chart, and there it was. Here, I only trade the Dow. Here was this during the day. The market had come down, and at the time when I switched on my computer, I think it was here. Lovely test in a rising market. Here's our very high volume. Oh, see, but I was cautious because obviously in mind I'm thinking the market is weak, but this was some overall for daily, but this was screaming out. Here's the very high volume, stopping volume here. Next bar is also a down bar, but very low volume. The program is saying strength is coming in, so there's no more interest in this level down here where we had all this high volume. The market went up as a result, of course, so we know that was all buying down here. And then here's our confirmation. Like I say, we always look for some confirmation to be as sure as we can in a trade, and there it is. It's a very low volume test. It's come down here, come up to here. It's a test in a rising market, and look what happened as a result of that. And so of course yesterday finished an up day. So that was the trade that I did yesterday. Very happy with that, because I wasn't even expecting to trade. But once you learn these principles, this is a setup to anyone who's new. Once you learn these, it's a very visual thing. You look at your chart and there it will be. After a while, once you practice and you've seen enough of these, you can there it will be, and you'll recognize it. As Tom says, you'll recognize it. And you can, when you see something that's really nicely obvious, only trade something that's obvious, because that will give you confidence to stick with it and to get into the trade. Don't hesitate. When you see something like that, it's not a very good time. If you hesitate, you can miss the move, and then you'll lose your confidence once you start to see the market moving up, and they don't give you, quite often they won't give you another chance. They won't give you another nice signal like that, and then if you start getting in as the market's gone up, your confidence starts to dwindle as well, and whatever they do, their tricks, shakeouts and all sorts of things will shake you out and play on your confidence. Oh gosh, hang on a minute, there's loads of questions. Oh yeah, well Tom also mentioned his simple trending system, which of course comes into play here. Moving up with each up bar, allow for, is it 2 down bars, Tom? 1 down bar, and ignore level bars, and you can stay in. Now I don't know. I took 25 points profit because I'm still building up my account. I want to be sure. I just wanted to take my target, and I did. But as I say, with more increasing confidence, the more I do this, the longer I can stay in. So I'm sorry, I'm not looking at the screen because there's some questions. Blah 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 blah. Why did I choose Dow? I think there's a long historical thing to that. When I was learning and making tons and tons of mistakes and losing money, I found that the Dow I just got more comfortable with the Dow. I found that the signals were more reliable. It behaved itself. Well, usually, yeah. Obviously, it's not always, but I found that it behaved itself, and I'm quite comfortable with it. So I just stuck with it. And also, I don't like to flit around from one chart to another. I like to focus on a chart, understand it, watch what it's doing, get a feel before I place a trade. Thomas, do I only trade off the 20-minute? Oh, no, I don't. But I will. I'll always look at the longer time frames first, the daily obviously first, the hourly, the half hourly, and I've got all sorts of time frames up there: 20, 15, 10-minute, 5-minute, 3-minute, 1 minute, and but what I like to see ideally is something in the 20, 15 or 10 minutes, because that gives it more fuel. But I've been in on, if I've seen a test in a 5-minute, I've gone in on that as well. So no, I use lots of, and obviously I'm showing you a 20-minute, but I'll often look at all the other time frames to make sure that all the odds are in my favour. So if you start seeing things that are contradictory, then you need to be a little cautious about that. But I mean, this market was a pretty obvious, clear one. Andrew, you bought with red diamonds. Yeah, I did. I don't use the diamond system. I don't follow the diamond system. I follow purely my husband's saying diamonds are kind of the moving average. I just follow VSA quite simply. There is a setup. That's it. Once you see a setup, that's it. It doesn't matter to me what the diamonds are doing. Where was your stop loss? I had my stop loss at 20 points away, but Tom will always tell you, and I've been caught out a few times, put your stop underneath the last high volume, the last reaction down the bottom there, because they will sometimes come down and test that. So that's the answer to that. Okay, that's all questions on that. I'm just deleting some things. Okay. Edmund is saying there's some good VSA principles in the Canadian dollar. Which, is that up there, Pete, or is it, we got it, oh we have, 6. Do you have a particular time? Oh, daily. Oh, thanks. We haven't got. It is. He said 60. That Tom, oh yes. Do you want to talk about that, Tom? Edmund's pointed it out. That's the daily of the Canadian dollar.
Well, at first glance, it certainly looks weak, doesn't it? That's the first time I've looked at this. But what we want, first of all, what I want to know is there any stopping volume in the background? Is there any high volume on these down bars? Now here, be a red down bar. No. If there's any high volume, it's on that blue up bar, although it's got a sign of strength on it, because that would be like a reversal there. Right. So there must be a little bit of strength there. But I'd like to see very, very high volume coming in on the down bars. Right. Now here, it's something similar setup to what Rita was just showing you, look. That there's no selling pressure at all, look.
Test.
It's a test. Right. They've marked it down. The volume is very, very low. That means that the professional side of the trade here, they're not interested in selling. And they must have bought probably around here somewhere. There's a bit of high volume there, or even as a red down bar look. But this immediately following these high volumes here, right, shows that there is no selling pressure. That means that this is likely to go up. Okay, so we've got two up bars, a red down bar look. We'd like to see it possibly coming back down into this level. Up bar, a little bit of supply present still. Now here, you see, don't forget it's called volume spread analysis. That means not only the volume, which is low, but the spread is narrow, which also indicates there's no selling pressure on the bar. It's also closed in the middle look. And that's why it's gone up. But to me, that does not look strong, because I'd like to see a lot more buying through here. Yes, it may go up a few bars, but certainly doesn't look like a setup to me. I want more confirmation. I want something like Rita showed you on that previous chart. The trouble with trading is that it's like going out hunting. If you're that type, you've got to know your quarry, know what you're looking for, and when you see it, recognize it. If you follow the principles of these setups, then it has to go in your favor, because that's the way it works. Put that other chart up you had.
There is one question on this one.
Yes.
If there's no selling pressure on the down move, does that mean that it is likely short covering?
No, what it means is that the professional money are not panicking and not selling. That's what it means. Don't try to get now. What's a good thing with this is don't try to be too clever. Don't try to read things in it that you hear on TV or read in magazines or newspapers. They may sound good, they may sound highly intelligent, but don't get too clever. The market works on supply and demand. If they mark it down, that's a red bar, into an area where previously there was fairly high volume and the volume is now low, that's nothing to do with short covering. That's what that is no selling pressure.
That's that chart, Tom, that my 20-minute Dow that you...
Oh, this is your, now, you see, because she only specializes in the Dow, right, she's not scampering around looking for everything. Now, look, when you see these principles occur, this is how the market works, right? The market falls. So when it falls, you've got to have that vulnerability. It's all right. Put it back. Yeah, see, when the market falls, yes, you have to have that vulnerability behind you. Now, it's a red down bar. It's a fairly widely spread look. In other words, it's been vigorously marked down. But look at that massive volume. And on that volume, or on that activity, it's closed near the high, look. So it has to be buying. What else can it be? What else can that high volume activity be other than buying? I mean, once you see the principle, that's it. It's there. There's no good arguing this or that or the news or anything like that. That's it. Professional money have stepped in and buying. Now, the very next bar is down as well. That's all right. But the volume immediately fell off quite dramatically, look. Because the people that put their money in here are no longer interested in lower prices. They bought here, right? They know they're going to get higher prices. And then what we then want to know is a test. And there's a test, look. It's back down into this area, look. And there's a low volume, look. There is no further professional selling. That's why it's gone up. Now, once you see that, it's no good thinking, oh, well, the news is bad, or this is happening, or that. It's not. That's it. That tells you clearly that market's going to go up until you see a sign of weakness, which is usually high volume in up bar or no demand or anything. And this, of course, is what we call a testing and rising market. The trading system always seems to work quite well, look. It's simple. Can't argue against it. Blue bar, it's going up. Right? Allow for one down bar. Now, what's interesting here, I've mentioned this dozens of times, I think. When you see a rising market, especially if you remember you've got this right behind you, right, the red arrow appears, but the next bar is a test. There's a test, look. It's a red down bar, narrow spread, low volume, that's going up. Test the rising market. Up, and then you get your first signs of weakness coming in. And then you probably don't want to. Now we're in today, look. And what we reckon here, it's not going anywhere. Okay? But if you could learn those lessons, what Rita and I've just told you, then that's it.
Okay, thanks, Tom. Is there anybody in the room who is fairly new? Just asking, because sometimes it's worth going over a couple of principles, if there are. Because there are some very basic principles that must not be missed, otherwise you won't know what Tom's talking about. Let's have a look. Carlos is asking, can we do a 20-minute gold? Unfortunately, Carlos, we don't have the data for that. We've got end of day for yesterday, if that's any good. And Eleni wants to be new. New again, presumably. We can see if we can arrange that later. So, gold, okay. So we'll go to the continuous contract for gold, and that's live up until, well, not live, that's complete up to yesterday. Over to you, Tom.
What is gold?
Yeah.
Now, these charts thrown at me like this, haven't seen these charts before, so they're new to me as they are to you, right? But here we can see why it went up a little bit. There's the volume coming in on these red down bars, look. There is a little bit of supply on that blue bar there, or it's black. But there was some buying there, look, definitely. And look, we've got loads of signals here, telling us that fact. Okay, now, what we're looking for once we see that, if it's going to be bullish, it'll test and go up. We'd like to see it come back down to this level, though. What's this, gold? Yes. Right, okay. So we see these red down bars. There's not a lot of selling pressure, but there's nothing to indicate that we should jump in and buy it, look. Although we know there was some buying there. Only trade the obvious. Now there's a red signal, look. That's no demand. And then we have a test of some sort there, look. So we know the market's not responding to this weakness. I personally can't see any reason why I should jump in and buy that, or why I should jump in and sell it. I mean, you can take a chance, but I'm not in that business. I like to see something fairly certain. Like Rita showed you there, I like to see a setup. Okay.
You mentioned supply, Tom. What bar, Peter? Yep. So, Tom, there's another Tom here saying, "Where do you see the supply, Tom, on that bar?" What bar were you talking about? Which bar was Tom talking about at the time? They're actually blue bars, but I think Tom's eyesight is reading it as black. The first blue bar, yes. So did you talk about supply on this, Tom? So how do you know there's supply? That's what. Yes. Do you want to say that?
You've only got to look at the volume. That's why we call it volume spread analysis. Volume is activity. High volume, high activity means there's a lot of supply there, right? Now, I don't specialize in gold, but it's a tricky business trading gold because there's so many traders in there, lots of amateurs, and lots of them don't know what they're doing, and therefore these markets can churn around and have liberty taken with them. But high markets don't like high volume on bars, generally speaking, especially up bars.
There's a general question here from Chris asking about support and resistance and trend channels. Which ones are stronger in your experience? Horizontal support or resistance, or trend channel support or resistance?
Well, you can't say one is stronger than the other. They're potential support or supply lines. And when the data reaches those areas, then usually the market, the way it behaves, tell you what's going on there. So we don't use formulas. We don't use price patterns built in cement, stone. You have to read the market as it unfolds. And trend lines or horizontal lines are a guide for you. You can't categorically say that is definitely support and that one isn't. Okay? But you'll get it, don't worry. It'll come to you.
Okay, Tom, thank you. Anybody got any requests for a particular chart for Tom to look at? If you have, type it into the questions box. CLF, we've been requested. Let's have a look, see if we got it. Cliff's probably natural something or other. Okay, so this is a stock by the look of it. Tom?
Well, this stock... Right, well, what's this? Right, a quick look at this chart. Looks weak to me. Why does it look weak? Well, you take at this bar here, look. It's an up bar. There's a high activity, high volume. It tries to go up, close the middle, that's weakness. Professional money see that immediately. And that's why there's no demand on these bars, and that's an up thrust, look. Look. That's why it's come off like that. So immediately looking at it, it's weak. You need to see, if to see strength, you need to see stopping volume appearing. Now even this one, look. It's an up bar. Markets don't like high volume and up bars. That's why it's not going anywhere, look. Weekly? Monthly. Right, monthly chart. Well, that's an up bar, look. Well, it's a level bar. It's a downtrend, look.
That's an up bar.
What, in black?
Yeah, it is blue actually, it's just a very dark.
Oh, is it?
Yeah,
sorry, I can't see it. There's supply there, look. I certainly wouldn't be buying that. No way.
So, Tom, I'm going to ask a question here because it might be a question going through a lot of other people's minds, because everyone's thinking to themselves, oh, high volume on a down bar means buying, for example, and someone might just happen to look at this particular bar and think, oh, in fact actually there's a signal bag holding, it says. The program says bag holding. And then they'll see this and think, oh, low volume. Possibly they would. What's influencing your reading of this chart?
Well, I must admit there is a bit of buying there and a bit of selling. We're very vulnerable. Probably it's attractive because you've got this fairly substantial down move, look. Right? Now, we don't know the individual traders in this. If that was true bag holding, is it? Is that what it says?
It says bag, yes.
Well, don't forget you're only looking at the computer here. Normally, bag holding is gap down, the spread is narrower than that, and the volume would be much higher. It's a bit of buying come in, admittedly, but it's immediately followed, look, by high volume up bar. So we don't know who's been buying it, but somebody's buying, and then next bar they're panicking, look, and dumping it all. But there's not a lot of selling pressure on that bar. Not convincing, that's a good word. So why should I be interested in that when there's so many other possibilities?
Okay, we're just looking. No, TSM for mother. Is that right, Ming? TSM. We're just looking for it. Is it under another? Yep, it is TSM for mother. TSM daily. Yeah.
Right, at least you've got a move down. And look how that trading system works, look. Red this time. You allow for one up bar. That would be on no demand. Interesting, isn't it? Because that's how it works. Now here, right at the bottom here, you are vulnerable, but is there stopping volume there? Okay, there's a couple of arrows appeared, probably indicating there's not a lot of supply on that bar. Right, it drifts up on that, but then you get a surge of high volume and up bar. Markets don't like high volume and up bars, right? And they need to come back down to this level. They need to accumulate. There's not enough accumulation here to make that stock go into any sort of bull move. There's not a lot of selling pressure. That's why it went up a bar. But notice the volume is fairly high. This stock's going nowhere at the moment.
A question here from Robert. He has two questions. We'll start with the first one. I'm curious about principles that Tom uses for stop loss management, i.e. for setting the initial one and then for moving it as the price moves. Oh, the other question is, does Tom use price projections to figure out potential targets, or perhaps the position is always closed by a stop loss, or perhaps based on some other criteria? So, first one is stop loss.
Where would I put stop losses? If I was going long, I'd put the stop on an odd number under the last reaction. Might be there, look. Under the last area of support. Don't forget, a stop loss is not there to make you money. It's there to stop you being wiped out. Right? If I was shorting, I'd do the opposite. I'd have my short over the last rally on odd number. Because the herd uses even numbers. If you go to a public auction and you really would like to buy something, you stand a far, far better chance if the item is, say, $200, right, and you will decide to go to $205 or $207. Because lots of people say, oh, I'm only paying $200 for that, and that's it. Because you're looking at herd behavior. They take all that into consideration, which may seem trivial to you, but isn't.
And what about targets?
I never go for targets. Why should I? Why should I go for a target?
So how do you decide then, okay,
If you see a principle, like Rita showed you that one just now, then you stay long until you see a sign of weakness appear. That'd be your target.
go in here, and if you had got in here, here's a sign of weakness.
Yeah. Markets don't like high volume and up bars. But, you know, there you are. Once you learn to read these charts, your skill as a trader kicks in. And there are so many ways you can trade these charts. We have people making quite a bit of money buying and selling options. or trading options. I mean, for example, Rita and Peter, they're not in it more than, what, 10 minutes?
Just 4 seconds, Max.
How many?
Well, sometimes we could be in there for an hour or two, but commonly it can be as low as 2 or 3 minutes or less even.
2 or 3 minutes.
See a test, get in, you make money.
Yeah, exactly. So it all depends your skill of reading the charts and your ability to take action, and that's what makes it so interesting and exciting.
So everyone has their own way of looking at things.
Well, they definitely do. They definitely, individuals, there's so many different ways you can trade these markets. So it's not just a simple case of, well, buy here and sell there. If you're trading longer term, like a fund manager, then that's another different story. And you trade stocks acting stronger or weaker than the index on, say, a monthly, or I've seen these charts on a quarterly, and they still work. I remember years ago, I had somebody that went to a lot of pains and drew a chart up on a quarterly basis, and lo and behold, all the signals were jumping up, and they were very good too. Okay.
Thanks, Tom. Yeah, somebody asked me, this is Peter speaking, somebody asked me the other day, how long would it take them to learn how to trade the markets using VSA? So, of course, I had to say that I don't know, but that it was a bit like other activities in life, that anything that's worth doing isn't necessarily easy. It might be simple, but it might not be easy. And secondly, it does require effort. So the first thing I thought of as I looked down the bottom of our garden was, Rita's looking at me, was there's a few weeds down there. And we all know that if you want to have a vegetable garden that's currently got weeds or grass on it, there's a lot of work to do before you get the fruit right at the end. So I thought that learning VSA was a bit like that. In other words, you do have to spend an effort, and you do have to spend some time doing the groundwork for yourself. You know, if you're a member of the VSA club and you read and you look and you learn, then you're building up your expertise. And ultimately, when you've done all the groundwork, then you could perhaps be thinking, I can see how this works, and start making money. So it's not a 5-minute thing, unless you're very clever, I suppose, I don't know. Or you're very skilled in other ways, and you're just adding VSA to your toolkit, if you like. But just from scratch, I thought, yeah, there's a bit of work to do first. And it's worth it. Anything that's worth having isn't automatically easy. Otherwise, everyone will be doing it, and it wouldn't be there. And I'm saying that purely because no one's asking any questions.
There is one.
Oh, there's one question coming from, is that from Peter?
Peter, what's Tom's opinion about the direction of the market now?
So just repeat that. What's Tom's opinion about the direction of the market?
I don't know if you want something out. That's the 15-minute.
Right. This is 15-minute of the S&P. Well, to me, it looks it's now. Don't forget it's Friday, and don't forget that there's still an hour or two before the market closes. And because they're devious and crafty, they may mark this up to trap you near the end. So you have to be very, very careful and cagey. But overall, let me have a look at the daily chart here. Now, end of the day. Seems to be marked up already, as you can see, look. But this is weakness in the background. And I wouldn't think that there's enough cause there, although there's a little bit of buying there, look. Right, I saw this happening here, which a sign of strength suddenly appeared. But I would think they might mark this up, because I think the overall market's weak, and I think that market's going to fall. It's an unfolding story. You can't say this time next week or next year it'll be this or that. No, you can generalize by the weakness in the background. Look, this to me looks like a distributing market, and to distribute they have to hold it up at times, and usually that's seen by high volume and up bars. Now, we haven't checked the KG chart, have we, on the daily? Now, the KG chart's very good. S&P 500 daily chart. That's now the KG.
So far,
there's red there, look. All the time those bars are red, that market's weak.
That's of course up to yesterday.
That's only up to yesterday. Okay, so check the KG chart. All the time it's green, it's bullish. And you would be ill-advised to trade against that. When you see those bars green, you'd be ill-advised to start shorting. If they're red, you'd be ill-advised to go long until you see something obvious. But to me, the market looks weak. Although don't forget, it's devious, it's cunning. They'll whipsaw it around, ram it up, ram it down, do all sorts of things, because you are not in their interest of helping you at all. You are just there to become one of the losers.
We don't have KG on lower time frame. Yes.
Yeah, a question there from Gregory. Do we have KG on lower time frames? No is the answer, unfortunately. I'll let Rita read that one out.
Tom, the question on this again from Craig. On the KG chart, what does it mean when there are bars that are part green and part red?
Well, when you think about it, it's pretty obvious, isn't it? When the bars are red, they're acting bearish. When the bars are green, they're acting bullish. The market has to follow its own rules. And the main rule it has to follow is bullish volume, is expanding volume on up bars while decreasing on down bars. That's why you get testing, right? The volume is low. Bearish volume is the other way round. It increases on down bars, increase on down bars, and decreasing on up bars. That's why you get no demand, and up thrust, things like that. That's why the volume's low on them. And that's how the market works. There's nothing complicated about it. It's a matter of you having the ability to spot it, see it. And I think you'll find the KG chart, the way we've got it, is probably the closest thing you'll ever see on helping you in this way.
I hope that answers your question. Okay, folks, so that's it for this week. We'll be back next week, I'm quite sure, or almost sure. That's the schedule. And are we doing a newsletter this week? Sunday, we're doing a newsletter. Is that right, Tom? Yeah. So we'll be posting that up on Sunday afternoon. The recording, all being well, will go up sometime today. The recording of today's session. And we thank you for coming, and we look forward to seeing you next week. Rita, what were you saying?
Question for me, but I'll do it. I'll type it in.
Well, we might. A question just came in for Rita. Shall I just pass it over?
Okay, yeah, Grigory's asking daily kg on the Dow yesterday was red. Are you using it? I don't trade day. Because I'm scalping as such. I just go for the time frames, the hourly. So I don't kind of follow the kg chart on a daily basis for myself. So that's that. And one other thing is certainly confirmed to me this week is much that everybody is happy, to teach about VSA and all that, but you must read your chart. The times that I've listened to all sorts of information from all sorts of people about the Fed pumping in money and the news and all sorts of things, and it does put in the back of your mind, gives you some kind of opinion about or bias, even though you tell yourself not to. It does give you a bias. If your chart's saying something different, believe your chart. The chart is what tells the story, and that's been confirmed to us many a time. As Tom says, we are our own worst enemy, and it's true. Our own brain can talk us into and out of all sorts of things based on all sorts of information, but the chart is what tells the truth, and the chart is the simplest form of that truth. So on that note, we will say goodbye, see you next week, and newsletter Sunday. Have a great week. Bye-bye.